Welcome, everybody, and thank you for joining us today for this special private investor meeting with Urban Gateway. I'm Tian Wong, founder and host of the Big Idea Connectpreneur community. We're a global community of over 25,000 investors, founders, and business leaders from around the world. And I'm also CEO of Opus 8, which helps companies and alternative investment managers raise money through our network of accredited private investors, angels, and family offices throughout the U.S. Today's meeting with Urban Gateway is scheduled for 60 minutes. We will record the meeting and we'll share the recording with you afterwards so that you'll be able to watch it again or share it with partners or co-investors. We're going to have a 20-minute presentation by our CEO and chairman, followed by a 30 to 40-minute Q&A period, which will be moderated by Skylar, who is our co-host. So if you have any questions for our presenters, please type them directly into the group chat, or you can private chat with Skylar, or you can just raise your hand and we'll call on you once we start the Q&A. So a little bit about the company. Urban Gateway is a Hong Kong-based venture studio. They're reimagining the urban environment for climate impact in Asia Pacific. Company is currently raising $2.4 million, and they only have $800,000 left in this round. Over the last 2 years, Urban Gateway has built out 3 diverse climate action-driven companies, all serving multi-billion-dollar market segments, and they're related to waste to value, cooling, and virtual power. The first 2 businesses already have management teams in place, and they are in process with external fundraising with some major institutional investors. And they are proving the technology commercialization potential for the third company, and they expect by the year end to have a management team in place and also to be commencing external fundraising. So a couple of key considerations on the investment side. Number one is huge market potential. Respondents to the 2022 World Economic Forum Global Risk Perception Survey ranked climate action failure as a #1 risk with potentially the most severe impact over the next decade. China emits 27% of the world's greenhouse gases, which is more greenhouse gas than the entire developed country, other countries combined. US is number 2 at 11%. And there's no reality in which climate action can ignore China, and China has vowed to reach net zero emissions by 2060 with a peak no later than 2030. The second investment consideration is a very unique business model. The company's venture studio model is not like any other venture studio. They acquire Series A companies at angel investment levels. They acquire from them the rights to proven technologies that can deliver climate impact today in these massive markets. Urban Gateway then proves the tech commercialization potential first. They assemble a leading team of great managers, and then they will then help incubate and finance the business. Exit horizons are 3 to 5 years, and the studio cash flow is generated from the portfolio company's dividends and management fees. As I mentioned earlier, the company has a proven concept. They are well on their way with the first 2 portfolio companies, and they expect the third portfolio company to have a full management team and funding by year end. The team itself is a world-class team. The executive leadership and board have a long history of successful billion-dollar-plus exits and dozens, if not centuries, of collective domain experience in working in Greater China and Asia Pacific. Also, proprietary deal flow. The company has a strong pipeline through Third Sphere, which is a technology sourcing partner. The principals of Third Sphere are the second largest shareholding group in Urban Gateway. They're also a venture capital fund. I think they've got 4 or 5 funds already, very successful. They've made over 100 investments over the last decade with several impressive exits, including at least 3 unicorns. And then finally, I would say investor traction. Company's already got a great group of investors. They've closed on 1.7 million of this current round. And the minimum check size is 50K. Investors at the 250K level will have additional incentives. And we're absolutely thrilled to have Urban Gateway's CEO, Tom McCawley, and Urban Gateway's chair, Anthony Millen, with us today. So now I'll turn it over to Tom, who can get things started. Tom, welcome, and thank you for sharing this awesome investment opportunity with us.
Great. Well, thank you, Tian and Skylar, for putting this all together, and everyone, those of you on the West Coast with me for waking up early, and the rest of you, good morning. Let me start by introducing myself. The relevant part of my history is the past 20 years I've been working in and with China for, the past 20 years, about 14 to 15 of which was spent in China. and I've spent about 20 years of my professional life outside the U.S. So my focus has been primarily Asia Pacific. My friend and partner, Anthony Millen, is our co-chair. I'd like him to briefly introduce himself, and I will step right into the presentation and get things going so we could get to your questions.
Great, thank you. Just briefly, my background is being a serial entrepreneur, a startup attorney, and a venture partner for over the last 20 plus years. Currently serve as a partner at Shulman Rogers, a law firm in DC, where I head up and founded our startup and emerging growth company practice, and a venture partner in Third Sphere, a leading venture capital fund focusing on early stage investments in the climate space. In that capacity, I've served with Tom as a co-founder of Urban Gateway. I'm a personal investor along with the other principals of Third Sphere in Urban Gateway, and serve as the chairman of the board. Thanks, Tom, back to you.
Great, Anthony, thanks. So Tien gave a good overview, I think, of everything I'm going to do. So I want to hit the highlights. We are a venture studio, and the idea behind it began with the realized opportunity that to have impact on climate in the world, we needed to focus on China, and China needed technologies, and many of those technologies were outside of China and were in the hands of small to medium-sized enterprises in various states. So Anthony, myself, and our other partner, Harry, thought what we could do is put together a studio to be able to help commercialize these technologies to deliver climate impact and attractive returns for our investors. The most interesting thing, I think, and this was a recent New Yorker article that we used, is most of the technologies we need today to replace fossil fuels and address climate change writ large are with us. We don't need 5 to 10 years of waiting in the lab to take real meaningful action. We just need to do something with those technologies. So that's an underlying premise of our business. Tien mentioned that climate action failure is number one risk. Maybe others feel differently, but we're clearly on the line that this is the biggest issue still facing the planet. And impacts are felt with us. And as Tien noted, you can't ignore China because 27% of our greenhouse gases come from it. That's more than the rest of the world combined. But there's wind to the sails on that side. In the past 20 years, I've seen monstrous change in China. And now with this new commitment to peaking emissions by 2030 and 2060, will continue to drive action in China. The size of the investment is staggering. There's many articles and items written on it, but this one from the Financial Times, we're looking at 163 billion a year over 4 decades. So there's tremendous opportunities and needs. The way China works is it all rolls down to the cities. Cities are ground zero. They're the ones who need to make things happen. And we can let you know firsthand that they're just looking for solutions, and their ability to reach, though, outside of China is small to non-existent. So they're really focused and really desirous of having climate solutions for their cities to be able to meet those goals. And then for us focusing on China, it's not just about climate impact in China. Asia Pacific is actually a monstrous region that has a lot of opportunities. And what we see China is the vehicle to scale the business, to achieve economies of scale. And then our goal is when we negotiate our rights, we usually negotiate for options on territories outside of China. So China becomes a launching pad for further expansion. Our business model, I'll highlight where we're different and then where we're similar to a venture studio, but it's a very unique idea. we've implemented and we've proven so far. And it starts with understanding the needs within the market, which technologies we believe would have rapid adoption potential that are supported by policy and would, again, have the winds to their back. So we ideate opportunities in these big market spaces for technologies. What we did then, and we have 3 companies now that we've done it for, we did searches for companies. We found these first 3, and we seeded our first 3 businesses in China based upon these foundational technologies. And what we do is, again, and instead of a venture studio where they're coming up with an idea and then developing a new product or service, we're starting with services that are already proven or technologies already proven in their local markets. And we're just essentially acquiring the capital rights. And our ante into the acquisition of those rights is the commitment to do product market fit, which is our 3rd stage. That's where all the action starts taking place on the ground in Greater China, where we localize the technology, develop pipeline, do and fund the first pilot contracts, and show that there is a there. Our venture studio then also provides all the back office services to the company. Once we've proven it'll work in the market to the degree that we feel it's necessary to prove, we begin scaling. So what we do is, instead of internalizing this, we hire a dedicated management team that has experience in this specific space that we are trying to develop. Then, rather than to continue funding that company, we start securing investments at the portfolio level. So that begins a dilution process of ourselves. But when we acquire these rights and when we start out, so far we've owned at a minimum 50% and up to 100% of these businesses. So then bringing in external capital for us is quite a lucrative idea. And when we start the whole business, we do have a line of sight and a thought process of being able to exit the investment on a 3 to 5 year horizon. So with this idea in the venture studio and the thesis that we could acquire these technologies and start building companies, we've already done this 3 times. Our first company, Interwaste, which I'll go into a little bit of detail on each of them, is that now has a very senior management team, full-time in place, an extended team. And we're in the process of raising a considerable sum of money directly into Interwaste. Intercool, we have our COO on board. We've proven the technology in the local market. We're building pipeline, and we're getting ready to kick off external investment directly into Intercool. And our 3rd and final business, which we're focused on right now, Intercloud, is in the product market fit stage currently. Anthony, as you know, as our chairman, is also part of Third Sphere, formerly known as Urban Us. They are a leading VC fund. They were ranked by Climate 50 as the #1 seed fund. They're an early stage VC fund. They're proven, I think Tien noted this earlier, over 100 investments, 3 climate unicorns, 6 exits. They've delivered real climate impact through these companies. They see thousands of companies. I think the number is 1,200 companies per year apply to the fund, and they only invest in a select few, but that provides us with a large opportunity, and in addition to their base. And as Anthony noted, the principals of Third Sphere are personal investors in the company. They share our vision and are collectively the 2nd largest shareholder group in our business. A question we always get, and we just put it up here, like, why would people put technology into our hands? 4 good reasons, we think, and 4 reasons we think are proven. The first is all these companies have a real option called China. None of the companies we're talking to have China on their horizon for at least 5 years, if not 10. So what we do is offer them the opportunity to start realizing profitability immediately from the region, and this is non-dilutive equity for them. The scale to which we could bring with respect to production reduces not only our cost of goods sold Asia, but because of the similarity and leverage of supply chain, we reduce their cost of goods sold. We reverse license. We just localized this one technology for EnterCloud. We invested in the localization. We're testing it now. With the concept of reverse licensing, this company who provided us with the technology and we improved upon it now has the worldwide rights outside of our region, and they are starting to deploy it in North America and South America. And so they got a product essentially for no investment on their side. And finally, there's a value multiple for them. And I think this was, again, just proven out in a round by EnterCloud, where they can show that there's global expansion potential for them in this case, in addition to moving them into new business models. And again, this is something we've done 3 times now. Our structure, we set up a holding company in the Caymans that's primarily for tax reasons. We have not just U.S. investors, but the majority of our current investors are non-U.S. And this is where we will be raising capital through our Cayman entity. We operate the studio in Hong Kong, and each of our subsidiaries are owned currently by the studio. Let me transition, I guess, with that, because I didn't go over the 4 companies. The one is a shell currently. It's an idea for next year. Our first company, and the one we're currently the most excited about because it's our most mature, is Interwaste. It's a sustainable infrastructure platform. We put $1 million into it. We have 55% ownership. It's on a fully diluted basis. It's 48. We put 13 to employee pool. But the key is that there's no further investment on our part needed. We have a management team in place who built and exited 2 similar companies. And in today's dollars, those exits will be valued at about $1.2 billion. We are signing, as a matter of fact, by the end of this week, a convertible note for $1.8 million, and we'll have the funding in place before the end of April, and that will be for project development. That note was signed on a $45 million cap with a 25% or a 25% discount. And in parallel, we're looking to raise $20 million in equity. We have 4 companies in due diligence, 2 large impact funds, one of the largest infrastructure banks in the world, and the largest waste to energy company in China currently in due diligence. The amount on the table is the $60 million pre-money on that raise. The foundational technology for this business is built on the idea of converting a broad range of waste. So not just food, not just municipal waste, tires, plastic, basically any waste that has energy into it, we can convert to a value-added product. We're currently focused on clean hydrogen and sustainable jet fuel. One of the things where actually what you'll see in this deck different than what Tien noted in the intro is between the time Tien put the intro out to everyone and today is we've finalized an exclusive technology agreement, so an enhancement of the current agreement we have. We have verbal agreement of terms with this technology provider. Definitive documents are in place, and this completely changes the game for us in the region, because this is a company who clearly has a unique positioning for this product. They've invested over $400 million into it, and we're very excited about this latest deal we're cutting with them. So some things are a bit dynamic because of that. The market is also very exciting because it's not focused in one area. This is very exciting because it's not just about producing, for example, clean hydrogen. It's also about taking care of the massive waste issues that exist in China and many other countries that we're focused on. It's a carbon negative to low carbon business. What that means is that on a negative side is we will actually save more CO2 than we produce. And we're targeting 10 million tons by 2030. So it's a substantial business. Our pipeline, we have our first project we're working to finalize. COVID continues to plague us now in China with shutdowns, but we anticipate finalizing that first project. We're already doing engineering on it, and we have multiple projects and MOU signed for other items. And for context, each one of these plants is a minimum 75 million US. They're typically about 150 million US investment. And what we're looking to do is to transition from developer to an owner operator. Based upon the two other companies our team has done, we feel very strongly that we're building a company valued within 5 years somewhere between $500 million to $1 billion. Second business is Enercool. This is a cooling as a service platform. The idea of cooling as a service is companies are typically replacing the cooling systems, for example, in hotels with new ones. They own the asset and they provide the cooling. That's the typical cooling as a service model. What we've done is we've acquired the rights to this technology. We have 100% ownership. This year, we will break even on our investment. We have our COO in place, and we continue search for building management. And our focus is to continue to grow that pipeline and get funding directly into that business for growth in the later part of this year. The technology we've acquired the rights to, bottom line, increases efficiency by 10+%, and it extends the equipment life. These exclusive technology rights we acquired via royalty payments. They're payable through 2025. We own it outright, and not just for Greater China, but for most of Asia Pacific. The market is focused on an area that a lot of focus is not on, and that's 50% of China's total cooling energy consumption is non-residential, and that's the market we're going after. The carbon negative side that we can state, we've already got through all carbon verification that we can trade on the EU voluntary market, and we're excited about stepping into China because their carbon market is taking off. Our pipeline, we're actually there today. We're working with the largest data center in the world, Equinix, on their Hong Kong platform, and then looking to reach to them globally, hopefully. Hong Kong Airport next month, the Regal Group, a large hotel group, and others are just some examples. And our growth strategy in this business is to develop pipeline, get cadence, get cash flow, and then look to acquire service companies, which gives us access to customer pipeline so that we could then go in and make offerings to acquire their cooling assets. But instead of replacing them with new assets, we would replace them. We would enhance them and extend their life. The last company, and I'll be wrapping up in a moment, is a 50-50 JV. We've been focused on localizing the hardware. Our first 100 units are coming off the production line. The energy management platform is online in China. And this foundational technology essentially looks to make mini split air conditioners. They're ubiquitous in China, actually everywhere outside of the US almost, into virtual power plants. And what that means is we will have the ability remotely to reduce loads during peak times, in addition to a few other benefits. One other very exciting piece of this that I think will accelerate adoption is we're working with a Fortune 50 company. We have an MOU with them. And through their filter technology, we could actually convert these mini splits also into air purifiers. So you wind up with a virtual power plant and an air purifier from the same unit. This 50-50 JV, we have an exclusive royalty-free and irrevocable license. So the technology partner essentially injected their IP for 50% of the rights. The market is 500 million existing air conditioners in China, 14 million new a year, that drive a huge amount of China's peak power. And our focus is on validating by getting 3,000 units by year end. Closing all this out, and just so you know, Anthony and I are sitting here in the US. I'm actually moving to Europe. That's why Europe stayed it there. But what you'll see is we have a very diverse team. Every single one of us, except for Harry, who's our baby, has over 30 years experience. And we've built, managed, and exit companies in the region. We're geographically diverse and distributed throughout Asia, US, and now Europe. And the reason that's important is for us to execute this model, we have to work with a lot of technologies outside of China, keep those partners engaged and comfortable, in addition to executing on the China side. And I think we've proven ourselves resilient because we've been doing this starting with the riots in Hong Kong and through COVID for 2 years now, and have done all that we've done. We also have a great advisory board, which we are continuing to expand. They have over a century, these 5 folks in capital markets and sustainable technology. They are very involved in our business. Rounding things out now on the funding side, we've raised $1.5 million on a convertible note so far. That's at a 20% discount, or $12.5 million cap. Just for context, our interest in Interwaste, based upon the convertible notes we're signing this week, will be valued at $21.6 million. And remember, that's at a 25% discount to what we're shooting for in the market. So that puts, just on that one business and neglecting the other 2 or any further potential, at $21.6 million. So we feel this cap is well justified. We are raising up to an additional $1.5 million, and again, we've changed some of that because of the dynamics around contracts that we are signing. The use of the funds are focused in 3 areas. As I mentioned, Interwaste, the one we signed the convertible note on, we need no further investment. So what we're looking for is funding to continue funding the venture studio, working capital for Intercool till we're completely cash positive by the end of the year, and getting us through market validation for EnterCloud. On a cash flow basis, we expect to be, by the end of next year, cash positive at the venture studio, and that will be from income from management fees to the companies, in addition to distributions. And we'll be targeting our next round after Interwaste closes on its equity round, which we anticipate later this year, and project finance close, again, which we hope will be the end of this year, if not before Spring Festival or Chinese New Year next year. So within the next 7 to 10 months, we expect to have that done. The Intercool raise, 4th quarter, we're expecting to have that done, and the market validation. These 3 things, we think, for our next round will drive a very significant value increase on that round. So that's it. Tien, Skylar, if you could help us moderate questions. Why don't you give the first one to Anthony so I can take a sip of my tea? And
Okay, perfect. The first question is, are there CO2 tax credits available? If so, can those credits be transferred to Urban Gateway from the venture entity?
Actually, so I'll take that first one.
Yeah.
So not CO2 tax credits per se on a project. So we're in conversations right now with this large data center to do what's referred to as programmatic, a programmatic carbon trading program, which would involve selling on the European voluntary market. And we would look to capture a share of that. And for our other projects in the mainland China, that board just opened last year. And as we begin to focus now and get projects going in the mainland, we expect to be able to either wholly own the credits and monetize them, or share them in partnership with the customer we're working with.
Okay, perfect. The next question is, how are you handling US and China tensions?
Okay, I'll answer that one also. So in general, we are a Chinese company. Our ultimate ownership's in the Cayman. It's a non-US majority. And our focus has been to maintain a neutral presence. So we're not a US company, is one very important thing from both sides. Second is technologies are either embedded in Intercool and EnterCloud, the technologies are embedded and are part of the Chinese entity, the Hong Kong entity. And the last business, Interwaste, it's a Canadian business, not a US business. And there's no sourcing of any proprietary hardware from the US. So when we designed the business and structure a couple of years ago, we knew we didn't want to get in the middle of potential tensions because of what was going on in the Trump administration and carried into this one. So we've done the structure. And then second, this space, when it comes to sustainability, it's not like issues that typically come up between the countries. As a matter of fact, it's one of the only issues that both countries can agree upon. So we think it's very low risk. And it's also not an area like finance, like education, where China has really clamped down on foreign participation. This is one where it's highly encouraged. So we feel between the space that we're in, a la sustainability, in addition to our structure, we've built something that is, I think, as I wouldn't use the word bulletproof, but as comfortable as you can be in executing in the mainland.
Okay, great. The next question says, can you give us an idea of how many startups you have in your funnel now and where you are in potentially investing in them? Or do you expect to wait on new acquisitions and investments until you're cash flow positive on the existing 3?
So let me answer part of it and then turn part of it to Anthony. So our focus right now is on the existing 3 technologies this year. So we want to be able to move them, as I said, into independent funding or product market fit. We are looking at technologies that we can add to these companies. So our model has 2 parts. One is we build a company based upon the foundational technology. That's why we use that word in the deck. And then we look at complementary technologies we could absorb. For example, in our EnerCloud business, we have an MOU with a company in South Africa that can make hot water heaters smart, cost effectively. And for us, that becomes a source of potential energy storage for renewable energy and fits really well into our EnerCloud platform. So we are discussing with them. For our Enerprop business, based upon talking to the market and what customers are looking for in 2023, and that will likely be the next round of funding, would be bringing in and building a brand new company. And let me let Anthony talk a bit about the pipeline from the third sphere standpoint.
Great. So as Tom mentioned, we do see and have visibility into a lot of technology around the world. And the focus now that we are in 3 multi-billion-dollar markets, as Tom said, at least into 2023, when we work on the PropTech Enerprop business, is going to be really focused on executing and on the growth of these current businesses that are in place. We will be opportunistic if there is a great technology to be bolted on to one of the 3 existing companies. We'll bolt it on, and so we're constantly reviewing technologies to see if it can incrementally add value or enhance any of the 3 existing companies. And that's the current strategy, is to just be opportunistic if it adds value to an existing platform. Otherwise, we'll be waiting until we've moved these companies through to the next phase.
Okay, great. We have another question that says, can you discuss the status of the first 2 portfolio companies in terms of raising institutional capital? What valuation and what is Urban Gateway's equity valued at?
Sure. So the first one, as we said, was Interwaste. That is converting municipal waste and other wastes. Our first projects will be into either clean hydrogen or sustainable jet fuel. That business, the note which we are executing this week, values the business on a pre-money cap at 45 million. We're looking to do a pre-money raise of 60 million. We feel much better about it now, given this exclusive technology licensing arrangement we are working on. So currently, based upon the cap, I think what I noted earlier, and I don't have the deck up, but it was around 21.6 million would be our interest in Interwaste, based upon our current ownership, which on a fully diluted basis is 48%, and the cap of that convertible note, which was 45 million US. So if we get 60 million, we'd be talking about our interest is worth closer to 30 million, 26, 27 million dollars in the first round. So I think in the first round of Interwaste, our interest should be somewhere between 20 to 30 million dollars. And as we noted, the investment we're looking for on this has a cap of 12.5. So we're looking at a 40+% discount just based upon the waste business. On Intercool, I'd love to give you exact numbers, but we're developing the strategy right now. We actually had meetings with Blackstone, and one of the conversations we had with them and what we're trying to pursue is a very aggressive M&A strategy of small service companies and then these infrastructure assets. So we're in the middle of building all that. But for a first round, we may only raise 2 or 3 million in terms of proof of concept. I think that would put our value easily at another $5 million because we have 100% ownership in that business. So the first round, raising 2 to 3 million on a 2 to 3x multiple, we're probably talking $5+ million for that business in the next round. And I wouldn't speculate on EnerCloud right now. We're still in the market fit stage, but it has. What I can tell you is that the technology we acquired, they just finished their Series A round, and we essentially have that technology, and they were valued at over 20 million. If you consider that we own half of it in Asia, and Asia's a bigger market, we're pretty comfortable with an attractive valuation on that business also once we get through product market fit. I hope that answers. If you have something specific, or maybe Anthony, you would like to address something maybe else on respect to that question.
I think you've covered again the value of the holding company that we're talking to the group today about investing in. At the $12.5 million cap, you can look at the value of the portfolio companies, and that's really a good way to get kind of an assessment on the overall value of the holding companies at stake in the portfolios, which you've addressed.
Okay, great. And we're going to continue with the Q&A. I'm just going to put up a quick poll just to get your interest level in Urban Gateway. But let's continue with the Q&A while that's up. So our next question is, would you elaborate a bit more on how unique the technologies that you have in your platform are? Perhaps use Intercool as an example. How would you use mini split HVAC into virtual power plant?
That's actually a great question. It's our EnerCloud business, but there's a lot of Eners, so it's easy to get confused. The mini split idea is actually built upon, if you look at what's in the US, Google Nest, for example, has their, I can't remember the name of the program now, but they essentially, you can have your thermostat turned down during peak days, for example, here in California with PG&E. The monetization of that is what's called demand response management. And the US has set up these structures so where through a device like Google Nest, or there's aggregators, or there's others, that you actually get paid to reduce load during peak times of the year. My other partner, Harry, who's not on here and is a founder, this was one of the core technologies based upon his space. He's also, and he works, he's an officer at a company about to go public. They're the largest technology company, software company in China. They write what's called energy dispatching software. That's the software that communicates between the grid and the power companies and how electricity is dispatched. Long story short, China is going under significant electric market reform. That significant market reform also involves things like demand response management. And my partner, Harry, is probably one of the most knowledgeable people in that space because, again, in addition to having written more than 50% of the dispatching software, they've also written half of the trading platforms, and they consult with every single government. So the idea Harry and I had in observing what's happening in the US and elsewhere with technologies like Google Nest, through the Third Sphere portfolio, we were introduced to a company who has a technology that would allow us to convert the infrared controls, which are on a mini split. The Google systems, for example, are a hard wire to the furnace in your home. This technology would allow us to be able to communicate via IR to the mini split and be able to take control. We've done some very unique modifications to that technology hardware to allow us to be able to deploy thousands of units quickly. So rather than trying to sell through Tmall or Taobao, the Amazon equivalents, we'll be doing project-focused large-scale deployments of this technology. When that technology allows us to be able to put the hardware online, we then can do things that are done here. And this company is doing, by the way, and is the leader in the US for energy demand management and other demand management controls for mini splits and other type of heaters. They are the market leader, and they're actually the only ones participating in some key states in programs related to this. So it's very unique, and it's not. But the key secret sauce is, again, in the software and the control and the algorithms associated with it. So our strategy then is to take this technology and their platform and start acquiring capacity really quickly in partnership with some large electric power players. So that's a lot of answer around, I think, what may be a difficult subject for some. But that's the depth of knowledge we have of the market, the insights we see into a product, and we're putting both of them together where they collectively create a very unique platform.
Okay, great. Our next question is kind of a two-part question, so I'll start with the first part. It says, how do you help startups accelerate during an incubation period, or are you usually looking to acquire technology rights to commercialize within an exit?
Yeah, so the answer is we're not looking to incubate or accelerate startups that are very early stage. All the technologies we've contracted with and are looking at, the technology is proven in the local market, and most of them are in the valley of debt stage, where they're either going to survive or not in terms of their ability to penetrate the market. We've identified the market. We look for technologies that are mature, but the teams or the companies do not have the capacity or the intestinal fortitude or the time to be able to step into the China market. So we come in with a strategy and an offer to be able to acquire their rights and to commercialize the product.
So I would just add there that the model is where we said the way this venture studio is structured, the Urban Gateway Venture Studio is structured, is that step one, it is identifying market needs based on tremendous domain knowledge of those particular markets. So very, very deep decades knowledge and understanding where those markets are moving over the next 5 to 10 to 20 years, and where the opportunities lie to inject disruptive technology to company build in those market opportunities. So step one, so rather than looking as a startup studio, as a venture studio around new technology startup companies, this is looking at taking this deep on the ground knowledge, identify the need, then through other aspects of the venture studio to identify and secure the technology that fits that need. And then the investment, which is a much lower investment than building, and much less risky than building new technologies and new companies from scratch. The investment is then just purely finding product market fit and localization of that technology. And that's where the venture studio team is really around those three areas of identifying the need, securing the technology, and validating the technology in the local market. And then the final step of the venture studio is to recruit and build the management teams and to capitalize the portfolio companies and kind of set them off on their growth trajectories, providing continued management services and strategic guidance. So that's really what it is around. As far as the technology labs and universities and corporate R&D, Urban Gateway is looking to partner with and work with a broad range of technology centers around identifying best of breed, market leading, de-risk proven technologies. So as long as those technologies are de-risked and proven and ready for commercial usage immediately, subject to some localization efforts, absolutely would be looking to work with other technology-oriented groups.
Right. Anthony, I think a great example is our Interwaste business. This is a company that's invested well over 400 million US into the technology. It's about to explode. What we were able to do is, starting with the market need and searching for technologies and engaging them, was first to build their confidence that we can develop projects and get the market kickstarted in China. And we grew that relationship such that what they realize as a young company, with not people and a huge exploding demand in Europe because of this reinvigorated focus of getting off of natural gas and looking for alternative fuels, in addition to projects in California and elsewhere in the US, they have their hands full and they just don't understand China. We've proven to them that we are a trustworthy partner, that they could trust us with their IP, they could trust us to execute. This updated agreement brings them into our business with some equity. And they are confident that the only way they're going to get anything done in China in the next 3 to 5 years, if not longer, is by working with us. And we are a much more attractive alternative to working with a giant Chinese company who they'd have a plethora of concerns with. They spent 6 years before in China, spent over $10 million, have nothing. Frankly speaking, our investment was about $1 million. We have the first project in a big pipeline. So the proof is in the pudding, and that's the kind of deals we want. Our Intercool business, this is an entrepreneur in New York who's been growing it locally for 10 years. He has no desire to enter the China market. We knew the need. We had the connection. We made a deal. He's very happy. And we're building a business off of it. So that's just an example of the way we look to engage. So when we source companies, it's not only for their mature technology, it's also working with Anthony, especially in my help, for structuring a deal that makes them comfortable. And the 3 deals we've done are 3 very different deals, custom tuned for their needs. Skylar, next question.
Yeah. So the second part of that question is, are you looking to partner with other technology labs, universities, or corporate R&D centers to help put together a complete solution while shaping the market product fit?
So we'd be looking to partner. So for example, in our Interwaste business, we're partnering with UNDP right now on a program to address and get China off of the idea of incinerating waste and to look at alternative ways to convert waste into a higher value added product. That will be with UNDP and Energy Foundation. So if it's related to expanding the market and especially trying to get policy adoption done, that's the type of partnerships that we're looking to, rather than R&D centers per se.
Okay, got it. The next question is, when a portfolio company exists, would the investors get the pro rata value from that particular exit at that time?
Yes, and I should have mentioned, it's one of the things Anthony emphasized that I should have done on the last slide. But so, for example, in the Interwaste case, we're very bullish on this. We think it's either an IPO or a trade sale, just based upon our team's experience. In either case, if it's an IPO, we would distribute to all investors the publicly traded shares. If it's a trade sale, we would send to the investors their pro rata portion of the cash. Is there anything else to add on that, Anthony?
No, just, and if it's a cash and stock sale, it would be pro rata share of cash and stock. But the idea is with each exit to move capital and or shares directly to investors to make their own decisions as to when they ultimately want to sell those shares. It's not pooled, and those decisions are not made at the holding company. They're distributed out at that time.
Okay, great. Next question says, what percentage of your deal flows come from the third sphere? Do you foresee other ways to source technologies?
So currently, 1 out of the 3, or 2 out of the 3. So from Anthony and the third sphere team, our EnterCloud and EnterCool business came. The other technologies we are currently looking at to complement EnterCloud and EnterCool, and actually there's an electrolysis company for Waste, are all coming from third sphere. They also have a large network, myself in the sustainability space, and our advisors. So we have a broader network than third sphere, but we are really relying on them, especially as we go forward with the Interprop business, and we step into things that are less heavy infrastructure, which is where more of our team's experience lie, and moving into IoT and other software-based solutions, which is where we want to go with Interprop. I think most of our deal sourcing will come from either their portfolio or their network. So I would put the probability for businesses that relate to IoT, machine learning, etc., 70% probability that it comes from third sphere. If it's heavy infrastructure related things like our Interwaste foundational technology, it's more likely to come from myself, my network, my partners, other partners' network, and our. Is that a fair answer, Anthony?
Yeah.
Okay, great. Next question. We have time just for a couple more. How are you doing this with only a small amount of money?
So one of the great things about this model, and we are really excited about the venture studio type that we built, is we don't need capital to build the technology. What we're doing is, in the Interwaste example, we couldn't afford to develop this. This was $400+ million in a decade. What we're committing to is proving market fits and then giving them a strategy and a pathway to which we could scale it. That does not require a lot of capital. Our team, myself, our advisory team, our executive team, third sphere, we're very experienced. We have deep relationships throughout the region, access to global technologies, which allow us to be able to cost effectively find them. So we don't have to put a lot into it. And sourcing and demonstration typically does not, again, take a lot of money for us to move from where we're at with EnterCloud or Interwaste, saying, hey, we proved it, it's attractive, now let's go out and get growth capital. And so those rounds come directly into the portfolio level. So we start at 50 to 100% ownership. We put a very modest sum of money and effort into the business. It's more in leveraging our know-how, our IP, if you will, and having somebody else put the money into to scale it and build it, and then hiring a team. So it really doesn't take much cash for us to be able to support the current business we have. And as we look to future rounds, we don't need a lot of money to start building other companies.
Anything I would add there is that while it's not capital intensive while we're not deploying, tremendous amounts of capital, we are creating significant value in these first steps. So you can see with Interwaste, even though the amount of capital that was deployed was around, Tom said, around $1 million so far, but with the knowledge and the expertise of the team, our ability to identify the opportunity, our ability to secure the technology, and then our ability to start the efforts moving forward along the first projects, we now have raised the first capital at the portfolio company level at a cap of 45 million, with a line of sight to raising the larger round at a 20 million, at a 60 million pre-money valuation. And so the value based on that cap that's been created for the holding company for Urban Gateway Energy, as Tom indicated, of that $1 million investment and the efforts of the team, is already, that stake on paper value is already at over 21 million, 21.6 million off of the $1 million that was deployed. And so the model is an extremely powerful business model. And the risk level in the business model is not nearly as high as the kind of risk that would be in a company that was just starting a new technology company from scratch. So we've engineered and designed through this venture studio this very, very powerful model for creating value.
Okay, great. Tom and Anthony, thank you so much. I know we're about out of time, so we want to be respectful of everyone's time as well. If anyone else has any burning questions that they'd like to ask, you can feel free to stay on. But otherwise, we will end the meeting here, and we'll follow up with you by the end of the day today, so everyone will have a copy of this deck and also the meeting recording. And you'll be able to get the emails for Tom and Anthony to follow up with them. So thank you guys so much.
Thank you, Skylar, Tien, everyone. We're available if anybody would like to stay, as Skylar noted.